The rising rate environment spurred by the Federal Reserve has proved to be nasty for growth stocks. Our next guest, though, says there are still opportunities with serious breakout potential within growth. BlackRock's U.S. head of Thematic and active equity ETFs, Jay Jacobs, is joining us right now. Jay, it's good to see you. I mean, there is this, I think, temptation on the part of investors right now to just be risk off entirely, particularly when it comes to growth. How should they be thinking about opportunities within growth and what their risk appetite should be?
Well, there's no doubt there's been a difficult market for growth this year, but this is exactly when investors should be relooking at this area of the market. A lot of these companies are down 20, 30, 40% this year. And the key is which of these companies have been harmed by the rising rate environment and which ones are actually going to emerge stronger. If you can get more targeted with your growth exposure to get into those companies that really are actually going to thrive in an inflationary environment, not only can you buy these companies at a discount, but you're also getting into a better fundamental story right now.
Okay, and so for a lot of people that are looking for value in ETFs, where should they be placing their attention?
Yeah, absolutely. So two areas that we're very focused on right now are infrastructure as well as clean energy. Infrastructure for several reasons. One is you have incredible growth tailwinds because of the Infrastructure Investments and Jobs Act, which passed last year, $1.2 trillion being pushed into U.S. infrastructure. And on top of that, these companies get to set their rates based off of inflation. They get to tie them to CPI. So when CPI goes up, the toll roads, the utilities, they get to raise their prices as well, which gives them a really nice inflation hedge. The second group of companies is clean energy in our iClean ETF, ICLN. These companies, they already paid the expenses. They built the wind turbines, they built the solar panels. They're just producing electricity and selling it often at the market rate. So a lot of those costs are front loaded. They're a bit insulated from inflationary pressures because they don't have to invest in their business as much. They don't have to buy fossil fuels at higher prices. So infrastructure and clean energy, we think, are very inflation resistant themes right now.
But Jay, are these ETFs recession resistant?
We believe they are because at the end of the day, where are people going to cut back their spending? It'll be discretionary spending. Maybe people will delay the purchase of a car or remodeling their house or going on a trip. But they will keep paying their electric bill. They will keep using water utilities and keep driving on toll roads. So infrastructure tends to be one of the most defensive industries out there from a revenue perspective. And clean energy as well, we think is going to be very resistant because people need to pay their electric bills.
I got to say, Jay, when I was reading these notes, I was getting a Kathy Wood. I was getting an ARC vibe with some of this stuff, right? When I'm looking at neuroscience or these sort of moonshot kinds of technologies, right? And so if that's true, maybe something like infrastructure might be recession resistant. But for some of this stuff, is it fair to say that people can expect some volatility before maybe eventually they're rewarded?
Yeah, absolutely. And we would look at this from a barbell approach. So infrastructure and clean energy, we see these as more resistant kind of inflation protected themes. But if you were look at the other end of the spectrum, kind of high growth moonshot technologies, yes, neuroscience is a really exciting space right now. We just saw for the first time in decades an Alzheimer's drug that is showing, real progress in slowing cognitive decline in Alzheimer's patients. So we're really excited about that. Just because we might be in a weaker economic environment, just because we have inflation, doesn't mean that innovation stops. But I absolutely agree with you. Investors need to understand the volatility. And I think the barbell approach of having some defensive themes as well as some offensive themes, I think is a good way to play it.
Jay, can companies continue the rate of investment in some of their ESG goals, even in the face of a recession? And what would that mean for their potential balance sheets and thus the trickle-through effect for investor sentiment?
This is an incredibly policy-driven market. So a lot of the incremental investment being spent right now is coming directly from the U.S. federal government or from other governments around the world. So, around, sustainability, we're looking at clean energy as one of those areas. We just have a $370 billion Inflation Reduction Act passed, which is putting more money into clean energy and electric vehicles. So I think there absolutely will be more investment, even in a recessionary environment, because we're seeing just the U.S. government playing such a big role in where money is being invested right now. It's not just the Inflation Reduction Act. We had the Chips and Science Act. We had the Infrastructure Investments and Jobs Act. These are all multi-$100 billion bills that are directing where money is going to be spent from the U.S. government going forward.
Jay, just lastly, while we have you here as well, on the EV front, we've heard a lot of chatter about whether or not capacity will exceed demand in the near term. How would you be monitoring the electric vehicle space, and especially given some of the not just newer companies, but legacy companies that have made swift movements into trying to make sure that they can bring up some of that production capacity in order to meet kind of this next wave of where the consumer is moving towards in a cleaner type of automotive offering on the market?
Yeah, I mean, it's a challenge. You look at a lot of different electric vehicles and you simply can't buy them right now. The F-150 Lightning, the Tesla Model 3 long range until recently, massively back ordered. The reality is that demand can move faster than supply. Supply chains from lithium production to battery production can take years to really ramp up scale, whereas a consumer can change their mind overnight once they, just ride an electric car for the first time. So absolutely, we have a supply and demand imbalance right now. But we are seeing so much investment from car manufacturers, again, from the U.S. government and the $370 billion Inflation Reduction Act. So there's a lot of money coming into this space, but it might take a few years to see that capacity increase.
Jay, thanks for being with us. Good to see you. BlackRock's U.S. head of Thematic and active equity ETFs, Jay Jacobs.